On today's Hot Sheet, I'm discussing Q2 home prices hitting a new record, Moody Analytics overvaluation scores for over 400 housing markets, and the latest mortgage application data for the past week. Today is Wednesday, August 13, 2025. I am Byron Lazine, and the Hot Sheet starts now. Live from Naples. Tuning in here to the Hot Sheet. Let me know where you are tuning in live from. It's the only show on the internet, Monday through Thursday, live, that goes through the housing market for real estate professionals. There's nothing better, by the way, than being classified as a real estate professional when it comes to tax time. Still to this day, it's the best qualification you can have with your CPA for a variety of reasons. But I digress. We got a whole bunch of data here. It's a big data day, middle of the week, middle of the month, middle of the dog days of summer. A lot going on, but obviously a lot of questions still unanswered. But we have some answers about where the housing market is right now and maybe where it's going. Are there going to be deals available in the end of the year and going into next year? If you spend any time on X, you see there's a clan on X. I'm pretty convinced that they actually work together to convince people that the housing market is a crumbling foundation. It's going to fall into the ground any day now. They've also been saying this for years. They told people in 2020, watch out. Don't buy. You're going to ruin your future. Everybody who bought in 2020 was really thankful they did. They doubled up by 22 in a lot of cases. Where are prices now, today, with all the fear that home prices are plummeting and the market is about to tank? Where do home prices sit today? All right. Well, home prices this is an NAR report, grew 1.7% year over year. That's right in line right now with where Logan Moshami Housing Wire's projection is for this entire year. We're talking year over year. This is for quarter two now in its entirety. So it's a little bit of backwards data. We're in the middle of August, so it's not that bad, but it's through June, obviously quarter two, 1.7% year over year on existing home price growth. That's what Logan has for the year of 2025, 1.7% year over year growth. In terms of real prices, as you factor inflation, would be negative home price growth, right? We're looking more for 3 when you're thinking about normal, healthy, okay? But 1.7% is still up. And that bumps existing home prices, now more than new home prices, at a median level across the country to $429,400, a new record high. So we're sitting at record high stock prices, which back in April, nobody thought was possible. Everybody thought the stock market was going to tank back in April. Those have obviously rebounded, and investors are now factoring in what I believe JP Morgan is projecting to be not one, LeBron James style, not one, not two, not three, not four, but 5 rate cuts before the end of the year, starting in September, which means they'd have to have double cuts, meaning 50 basis point cuts on some of these meetings. Yeah, that's right. JP Morgan has now said, and I'll find this really quick. Or Haley, if you want to find that, just came out within the last couple of days, JP Morgan projecting that the Fed will cut in September, along with 4 more cuts this year. I mean, look at this. Look what I woke up to this morning. You know how lame I am when I wake up to taking a look at what CME Group says. But CME Group says 99.9% chance now that there will be a cut. It was 80 yesterday. So CME Group is certain, almost 100% chance that in September, the Fed will be making a cut. They have that priced in at a 25 basis point cut. But we're at all these record highs right now, and investors are taking this in, and you're seeing what the stock market is doing. It's continuing to move up. Home prices, 429,000, record high for existing home prices. Okay, there's a lot of these high watermarks. The last piece of the puzzle for an economy which seems like, outside of some of the job concerns, seems like it's pretty much moving along. The big thing left is to get the rates down. JP Morgan projects Fed will cut rates in September and 4 total times this year. All right. Thank you, Haley, on that. So there you go. There's the news out of JP Morgan, how they're thinking about rates. That's a huge swing from where we were here just 30 days ago. If we break down by the 4 major regions, the Northeast year over year through quarter 2 is up 6.1%. Northeast has the lowest level of inventory out of the 4 regions. And that's creating an environment where you still have some bidding wars going on and pushing those prices up. Midwest, 328,800 is the median, and that's at 3.5%. Midwest, clearly, looking at the 4 regions, is today the opportunity for affordability. Somebody's working from home. Midwest is an option that's much more affordable than anywhere else in the country. In fact, there's some belief from those like Ivy Zellman that believes, the Midwest might be the spot in 10 years that retirees start moving towards. Okay, so the West comes in at 646,100. It's a 0.6% move up. And the South is 376,300. No change in the South, as prices are flat. And as we looked at yesterday, there are some places where prices are even moving down. Okay. We look here at, on this report from NAR, how many prices are moving down. Okay. They looked at 228 metro markets, 170 of them, 75% of these metro markets, now coming out of the regions and going a little bit deeper, a little bit more micro, 75% of these metro markets did post year-over-year gains, okay, in quarter 2. Now that's down, that 75% is down from 83% in quarter 1. So the deceleration of this home price growth continues to be the story in the housing market. There were 5% of markets that saw double-digit increases. That's down, though, from 11% in quarter 1. So just 1 quarter later, we're seeing pretty sizable dips on how many of these metros are experiencing year-over-year growth. That record high, 429,400, is spread out throughout the country. It's a 1.7% year-over-year gain, but it did again slow, similar trend, slow from quarter 1 where we saw 3.4% year-over-year growth. Where will we end up at the end of the year? There's an argument to be made that we could be flat or even slightly down. 24% of markets actually saw price declines according to NAR. So 1 out of 4 of the markets that they're following, of the 228 metro markets, saw annual price declines. That is up from 17% in quarter 1. So sizable jumps Q1 to Q2, kind of every way that you slice this, okay? If we look specifically at some of the metro markets that experienced the largest percent gains, okay, we've got 5 of them here. We've got number 1, Toledo, Ohio, at 10.5%. Now, the housing price there is 208,300, well below that 429 median. Speaking to the Midwest affordability, you can go buy a median house price in Toledo at 208,300. It's up 10.1%. When I see a price like that, If there's jobs anywhere kind of in spitting distance to support it, I would see 10% rips every single year. You can't build a house for 208,000. Okay. And I know somebody's gonna say, well, you can, just generally speaking, there's basically nowhere in the country you can build homes when you include the land for sure at 208,000. So you can buy land in a single family house existing for 208,000 Toledo. Yeah, I expect that to jump up 10.5%. I'd be shocked if it didn't. Jackson, Mississippi, another one under 300,000, 246,000 housing price, 10.5% jump. Qualifying income to buy a house in Jackson, Mississippi is 67,000. Qualifying income in Toledo, Ohio is 53,000. Okay, now we get into a couple of these higher price ones. I'll get to the Northeast there in a second. For Reading, Pennsylvania is up 8.3%, just over 300,000, still well below the median. You jump above the median, you've got New Haven, Milford, Connecticut. Haley lives in the region of New Haven. Up 9%, $432,000 housing price, is slightly above the national average. Qualifying income of $109,000 there to buy that similar home. I know that market very well. Obviously, the team in Connecticut cranks out units, a top unit mover in that region. And so there's just limited inventory, very suppressed inventory in that region. There's absolutely no building going on. And I'm not, exaggerating. There is no building of inventory happening in that region. You might have a little, somebody doing 6 lots over here or something like that. But generally speaking, there's no building. Nassau County, Suffolk County, New York, on the island, Bobby's neck of the woods, 9.6% up. And you're talking about a housing price of $800,000, qualifying income of 203,000. So there's your year-over-year largest percent gainers for metro areas. Okay, so near 10% on all of those. If we look at the next on the list here to round out a top 10, you got Springfield, Ohio, Montgomery, Alabama, Cleveland, and Rochester, New York. 10 most expensive markets right now, according to NAR: San Jose, Anaheim, San Francisco, Honolulu, San Diego, Monterey, and Thousand Oaks, and Paso Robles, LA, Boulder. What do we say? It's all in the West for these most expensive metros. Okay, so if we're looking at affordability, are there going to be opportunities for buyers to capitalize? Yesterday, we saw John Burns Consulting saying, hey, if you look through July, 35% of markets are down. Remember, this NAR data is saying 24%, but it's only through June, of markets are price declining. So if we look at John Burns from yesterday, you can go back and watch the replay, expect more markets to experience a price decline as we move our way through the rest of the year. Where are the opportunities then for buyers who understand, hey, it's better to be early, not late? Jerome Powell should take that advice. Better to be early, not late. It was much better to be an early housing buyer in COVID than a late one. 24% of markets experience declining home price. Okay, that's up from 17% last year. The 2,256 monthly mortgage payment on a typical existing single family home with a 20% down is a 6.5% increase quarter over quarter, 0.3% decrease year over year. So the monthly mortgage payment year over year is starting to decline. 25.7, and if we get rates to cooperate, it'll decline even more. That's going to be the biggest benefit buyers can have, is those rates. It's a rate sensitive business, whether we like it or not. 25.7% average share of income typical family spent on a mortgage is down. Okay, 26.9% from last year. So for the first time now, the affordability of home starting to trend in the right direction. I'm not claiming we have an affordable solution or affordable situation across housing. We certainly don't. There's a lot of variables that fit into that bag, but we are getting some movement, and rates can swing it the most. And we'll obviously keep our eye on where that goes moving forward. Okay, 38% plus share of income first-time homebuyers spent on monthly mortgage payments is down 40.6% year over year. Okay, this number was getting up into the mid 40s. The share of income first-time homebuyers are putting towards the mortgage is out of the 40s now. It's 38.7. And it's down 40% year over year. It's a good sign. It's also one of the reasons why we're at historic low levels on existing homes. Some people are just like, I'm tapping out, right? And we got to get those rates to obviously cooperate to get anywhere on that. Okay. So there you go. Headline is record 429,000 median home price. But there's 24% of markets seeing declines through quarter two. Burns Consulting that we saw yesterday says that number is 35%. So as we look forward, last 4.5 months of the year, what do we expect? The trends right now, the hard data that we have right now would suggest that there will be more markets moving down as we finish out the year. You also have that end of the year seasonality to pricing. Prices should be moving down, not up, as we finish out the end of the year. Kind of a huge rate swing setting aside. Okay. Here's some fundamentals to go over with a Moody's Analytics report. Okay. So back in 2022, the height of the pandemic housing boom, when people were, buying at that height, who were told in 2020 and 2021 by some of these doomers, don't buy. But then they were late to the game, kind of like Jerome was on inflation. I'm not name calling. I'm just saying the truth. He called it transitory. But when they were late to the game in 22, you saw this report, Moody's Analytics reported, hey, there's a lot of homes that are just overvalued. Things are starting to heat up. And Moody's estimated that U.S. home prices were overvalued back then by 29.4%. Okay, peak of the pandemic housing boom, Moody's Analytics puts this number out. They say near 30% of homes are overvalued. Watch out. Be careful. Okay, now we know places like the Northeast continued to go up after 2022, while Sunbelt states like the one I'm sitting in right now in Florida, we started to top off and then move down, a deceleration of the places where homes values are moving up, and certainly areas where home prices are going down. Okay, Moody's now 3 years later, end of Q2 25, has their updated overvaluation figure, and it comes in at 8.3%. So a huge swing now, fast forwarding to today. Moody's thinks U.S. home prices are overvalued by only 8.3%. So again, if I'm a buyer and I'm waiting for the bottom, this is valuable information. Okay, there's markets that, I guess we're seeing that homes are overvalued at 8.3% across the country, but there's markets where maybe it's starting to flip. And nobody can time the bottom, but do I want to be in the game negotiating early in that process while there's less buyers that have realized we're getting closer to it? Listen, next year, a lot of money coming in. Okay, it's one of the fears on inflation that there's going to be a lot of money coming in, not the money coming in from tariffs, but just coming into the economy. Mergers and acquisitions are up. Businesses feel more confident. The big ones feel more confident spending in and investing in to this economy. You do have trade deals that are investing in. You do have a bill that I could argue is going to be detrimental to long-term debt, but is going to bring money into the system in 2026. Okay, that tax or that keeping the taxes the same isn't going to take money out. Okay, so you've got a 2026 where there's potentially going to be more money flowing around. And if these rates move down, and people catch on to that, by the end of the spring, we could be talking about a situation where, 3-5% on home prices moving back up is kind of table stakes. It's maybe the low bar to jump over, maybe the floor by next end of spring. Right now, if we look at the U.S., Moody's again has us just under 9% of overvalued. Okay, so this positive number is well off of the peak of 30% that we saw in 2022 quarter two. Now, it only got as high as overvalued in, up in the low 20s in, call it 2000, I think this is 2006 here. And this is across the US. You had a time period where homes were undervalued. I remember having listings in 2012, 2013, and people were like, I think these are overvalued. And I'm like, really? I can't imagine that to be true. I mean, at some point, these folks are going to be literally giving the homes away, and people that bought in those timeframes, they were super nervous, they were skeptical. The world came crashing down, but they got some of the best deals I've ever seen in my life. And this one little period here where people didn't listen to the doomers and bought in 2020 and bought in at a low rate, obviously they too have made a great deal for themselves. So if we just look at the entire U.S. here, once again, we're sitting at a overvalued according to Moody's, and we had a time period here from 2014 to when things at the end of 2020 started to heat up, where we were essentially flat. I mean, you're talking about 3% here in the 18s and whatnot of overvalued, but really healthy, normal, flat, nothing to see here type of stuff for a period of 7 years. Now starting to come back to what Moody's would consider, where there's no swing, no undervalue, overvalue, no positive or negative component to this chart. Now, let's just take a couple big, and you could throw in the chat if you're interested. Throw your market out there if you're interested in your market or any other market, and I'll just pick a couple of the big ones and we'll take a look. If we look at Anaheim here, Anaheim today 22% overvalued according to Moody's. Again, I'm just going to take some big markets, but you can throw a couple in. I see Boulder popping up. Thank you for staying at the top of the alphabet for me. Boulder, Colorado. Boulder, Colorado now at the peak. Boulder was overvalued more than the U.S. It was overvalued by 31.3% and has come down considerably since that peak in 22 to 5.5%. So Boulder was above the consideration of the U.S. on the overvalued metric, up over 30%, now is under where the U.S. sits today at 5.5%. I'll try to take these in order. I see Houston on the list. Houston, Texas is got to be on here. Houston has got to be on here. Where are they? There they are. Houston. Okay, Houston now is still today at 33.7% according to Moody's. Okay, it's kind of like I'm talking to a seller right now. Hey, I'm not saying Houston's 33.7% overvalued. Okay, I don't know if Ivan will agree with me. I'm not saying it. Moody's is saying it. Same way we'd want to talk to a seller about what the market is saying. Hey, which way are you leaning? Which way are you leaning, Ivan? Do you believe Houston's 33.7% overvalued? This would include Pasadena and the Woodlands section there. All right. If we're going to look at Boston, greater Boston area, again, according to Moody's, we'll go up to Boston and take a look. That was right next to Boulder. Should have stayed in the neighborhood, not geographically, but on the list. 15% overvalued for Boston. Boston only got up to 18.6% in quarter two of 22. If you look back, I mean, the Northeast, for those of us that were in the mix here back in 05, 06, 07, I mean, the Northeast really shot up over where they should have back in those years, where this time around, you could say that maybe about a Florida where they were building like crazy, or parts of Texas. Okay. Where, if we go and look at where I'm sitting right now, I'll get away from your list and I'll just go to like in Naples, Southwest Florida here. I would imagine the overvaluation is crazy compared to most. Yeah, look at this, over 54% at the peak. So still today, it's come down a lot. Sellers are frustrated in Southwest Florida that have to sell. 21% overvalued. So more than double where the U.S. is at. But look at how high it got up over 54%. Now it got high during 2005 as well, is up over 40, but it got even higher on the overvalued metric this time around. Florida typically will have these bigger swings than other parts of the country. Boston, 28% during the great financial crisis, only 18% at the peak, now down to 15%. If we go to Dallas now, I see Dallas on the list. We'll take a look at Dallas region here. Dallas at 36.5%. So it's come off its peak of 53.1. And still sitting at an overvalued ratio according to Moody's of 36.5. So Dallas, right? If I'm seeing a number that's well above the national average on the overvalued metric on Moody's, it's like, okay, we probably haven't hit bottom yet. If we're seeing some pressure on price, there's probably more pressure on price here in the future. I see Indianapolis. Shout out to Indy. A little fun fact about Indy: Vanessa, senior editor at BAM, she went to Butler University. So great Butler University in Indianapolis. Indianapolis 36.6%. Now, here's what I'll say about Indianapolis: they're above their peak in Q2, but Indianapolis, one of the more affordable cities across the country. So Indianapolis, I could argue that, well, the affordability there, if you have migration patterns that support people who can kind of work from anywhere, it might continue to go up. 44.3%. Jacksonville at the peak, now today at 24.6. So the pressure on price has pushed affordability of Jacksonville obviously down. So there you go. There's some of the highlights regionally. If we look at, here's Miami. Let's just take a look at Miami. Miami's still overvalued by Moody's at 35%. The peak was only 45%. Let's see. There are some regions, and we haven't identified any, but there are some regions where a metro could be considered undervalued. Okay. And that's where the opportunities might be. Okay. If we look out of the 411 metros that Moody's analyzed, there's actually 24 that are already undervalued. There's been so much pressure that now Moody's says, hey, these 24 are undervalued. Where are they? San Francisco, 32.3% undervalued. You might look at prices in San Francisco and think that's crazy. Moody's says 32.3% undervalued. Here you go. Wildwood, Florida, 21% undervalued. Chico, California, 16%. San Jose, 14%. Midland, Texas, a lot of price pressure to the downside in Midland, Texas over the last 3 years. Now Moody's saying there's opportunity in Midland, 13. So the bottom might be behind Midland, or it might be coming up quickly, where the bottom in Dallas might be a little further out, right? Or the bottom in the Northeast certainly is not here, right? Grants Pass, Oregon, 11.9%. Napa, California, so secondary market, Napa, 11.2%. Alexandria, Louisiana is in double digits. Redding, California is in double digits. And then you've got Illinois, California, Santa Rosa, California, Fairbanks, Arkansas, Baton Rouge, Medford, Oregon, Montgomery, Alabama, Morgantown. Seattle's on the list at -4%, undervalued. And Baltimore's on the list too at negative 2.5%. Some of the bigger names, obviously, on the list. No offense to Pika, but I would say Baltimore maybe slightly bigger. Could be wrong, but just a guess there. All right, so there's your measurement between actual prices and prices historically consistent with wages, salaries, per capita, and construction costs. Only 24 of the 411 metros that Moody's analyzed are considered undervalued, but we're at a much different place than we were quarter two of 22, where almost 30% of metros were overvalued, I'm sorry, all metros were pretty much overvalued, but at 30%, now only at 8% on that number. We had some big percentage jumps on mortgage refinances here in the last week. Mortgage applications increased for the week on the headline 10.9% from the week prior. Mortgage Banker Association reports this week ending in August 8th. Okay, so obviously during that week, what do we see? We saw a 10-month low on the 30-year fixed mortgage. We saw a year-to-date low on the 30-year fixed mortgage. So we get these lows, and then all of a sudden, there's a huge pop on mortgage applications. Ooh, does that mean home purchases are going to come out of the historical low, existing home sale 4 million number and start to pop up? Not so fast. This was primarily driven, which is interesting, by the refinance index. It increased 23% from the previous week. So all of a sudden, a little movement on rates to year-to-date lows, and refinances jump 23% from the week prior, 8% higher than the same week a year ago. And the same week a year ago, we were basically at this rate, about 6.5. So that's an indicator to me. Home are looking to cash out some of their equity. It's an interesting thing to note. Like, okay, people need more liquidity right now, and they're using their home to get it, not going to sell the home to get the cash, but they're actually financing that cash. So really interesting there. Maybe you have a little bit of that of some folks that were high 7s or 8% that are trying to already refi down. Don't know, obviously, how much of that is made up from that category. But if we look at purchases, okay, only 1% increase from a week earlier. We'll take it. We'll take week over week increases on purchase index, but it's 1 point. We did have, for now, almost 30 weeks in a row, 17% higher than the same week a year ago. Again, multiple double-digit weeks in double-digit percentile when you look year over year. So purchase index are slowly improving, but this isn't a big enough number to suggest that, we're going to have some kind of pop on the sales into the future. We're just really crawling out of the basement here on the mortgage purchase application index. You can find more on that. And obviously all my slides and notes from every single hot sheet inside of BAMX. Just jump into the classroom tab on BAMX, whether you're on the mobile app, download the mobile app if you're a BAMX member, or on your desktop, go to the hot sheet and go to today. Every single day, post all of the slides that I use right here on the hot sheet, as well as my show notes and all of the interactive notes that associate with each and every single hot sheet. Along with that, every Friday, you get new this week content drops delivered directly to you. Access to our live role plays, which happen every Tuesday, and our live office hours. Today, it's Chris Benjamin going live at 4:30 Eastern time, 1:30 on the West Coast. Turn Instagram followers into real conversations. So not just posting content, but getting conversations from that content. It's Chris Benjamin. He's got his buddy Buckley in the house there. So that'll be today at 4:30 inside of BAMX. It's the #1 agent community to close more deals. And you can get into that at school.com/BAMX. I'd love to see you guys. There's a few of these left. BAM Camp, September 24th, Scottsdale, Arizona. We've got VIP sold out and the Mastermind in the morning sold out, obviously, but you can still come to the main event. And that's happening September 24th, Scottsdale, Arizona. The speaker list is sick, and a little secret that hasn't been announced yet, just for the hot sheet folks. We're going to be adding a speaker. BAM board member Sharon will be coming to BAM Camp, and we're going to be adding him to the list. So you don't see that on the landing page, but he will be there, just floating that out. I think a few dozen maybe, or maybe a couple dozen tickets left. So that's going to sell out quickly. Certainly when we make that announcement, it will sell out probably immediately. Okay. I know what I'm going to be doing on Saturday. I'll definitely be having a Saturday cigar, but along with that, I will be attending the most anticipated book launch in the history of book launches. This will be a record-setting book launch. I think there's some kind of Guinness Book of World Records that's going to be set on this deal. 100 million money model book from Alex Hormozi, friend of BAM. That's going to be August 16th. We're going to put a link down there if you want to join myself, Eric Simon, the broke agent, and Sharon Shrivatsa, BAM board member, in supporting that book launch. This is going to be, I don't care if you buy Alex Hormozi's book. He's a friend of BAM, and we like Alex, obviously. Don't care if you buy his book. But if you just want information on, like, it's a free event on a master class on how to launch and position product. They'll write a book on this ad campaign that Hormozi's running, and it's just a total masterclass on how to position product. I'm going to be most interested, obviously, in that as I attend that. But that'll be, I think, noon. Yeah, noon on Saturday, 9 a.m. Pacific time. So love to see you there. We've got a link down below that you can sign up for. It's totally free. Sign up using that link. Okay, 4.24 on the 10-year as we kick off the day. So trending in the right direction today. Again, CME Group says 100% chance, basically 99.9, that there'll be a rate cut in September. The 30-year fix yesterday stayed the same as the day prior. So first 2 days out of the chute here, 6.58 on the 30-year fixed. Maybe we get a move down and set a new year-to-date low. We got 6.55 on the board to beat to get there, but could see it with where the 10-year is today. Poly market has not caught up to CME Group. Poly market saying 87% chance of a cut, 7% on 50 basis, 80% on 25. So 13% on Poly market. These are actually, these are bets being placed. So real money being placed here on Poly market. 13% say no, not going to happen. CME Group is basically saying those 13% of folks are going to lose their money because there's a 99.9% chance that the Fed will cut in September. Okay, here's your hot sheet for today. Best way to support us, the simple way, subscribe to the channel. We believe at BAM, information should be free and accessible. Tell somebody about the hot sheet. We do it every Monday through Thursday. Subscribe, hit the notification bell, and share it with somebody you care about in the industry. Nowbam.com, no paywall. Information should be free and accessible. And then if you want the next level, helping you close deals, giving you the tools directly done for you, get into BAMX, and that's where you can close more deals. #1 agent community to get that done. All right. I will see you guys soon. Until then, of course, have a great day. Toodaloo.